It's a good question. So, I mean, policy pivots among central bankers have been 10 a penny over the course of the last 12 months. We do think, though, it's important to just focus kind of on the underlying strengths and drivers of the economy rather than necessarily what they're telling us, because what they're telling us can change pretty quickly. In Europe, I think there are kind of pressures that mean that the ECB will have to continue to soft pedal. The Italian problem, the recession risks driven by the sort of idiosyncratic commodity price spike through the gas price impact in Europe. In Japan, so far, they've been insulated from the big pickup in core inflation, in headline inflation, in wage growth that we've seen everywhere else. I mean, their policy is different because the conditions have been different. Clearly, there's a pain point, political pain point that is emerging through the depreciation of the yen. We think at some point the Bank of Japan have to turn just as everybody else has turned. I mean, if policy is ultimately unsustainable, that will get found out. And we can't have a situation where we have an ongoing divergence between what's happening in the Japanese economy and having it happening in every other OECD market, unless the Japanese authorities want the yen to continue to get trashed week after week, unless they want to get into a position where they own 100% of the JGB market, then at some point there will have to be a pivot. We don't know when that comes, but that risk is kind of there, and it's a pretty clear and present danger, we think, over the next 6 months.
Chris, the conversation of slower growth is a global one, and we had a terrific conversation on CNBC recently about even Singapore saying, look, if we have to slow the level of exports, that just may have to be one of the casualties because the economy's just been running too hot and it can't be sustained at this pace. If you think about that conversation globally, right here in England, as we talk about the action by the Bank of England to try and stem the growth we're seeing, but also, of course, the red hot inflation number, at what point do we have a conversation that goes from slower rate of growth to recession, and will that be tolerated, do you think, in some of these countries?
We think we're getting pretty close to that tipping point in Europe at the moment, and by Europe I'd kind of define it broadly, so include the UK, include Scandinavia. There's a common gas shock which is orders of magnitude bigger than the cost of living squeeze that's happening in other parts of the world. So we kind of have a common element to the global problem, and then an idiosyncratic European element, then that means that we think we're getting pretty close to a point at which we start having a recession discussion in Europe and the UK. What does that mean? Well, it's obviously not great news for asset prices, which are most particularly exposed to that element of the global growth dynamic. But I think we kind of then step back from that and move away from Europe to think about the world in aggregate. On our estimates, global growth is basically in line with trend over the course of the last couple of quarters. The forecast is then hugely dependent on what you assume about China's COVID policy and where that lands. But we don't see a big slowing at the global level, with a lot of kind of idiosyncratic things going on. You've got that weakness in Europe. You've got a likely recovery in China over the second half of the year, just because of the hole they've got themselves into with the zero COVID policy thus far. And the US consumer is reasonably insulated from what has been going on so far. Reasonably. I mean, it's not ideal for the US consumer conditions, but we have had such strong nominal wage growth, such strong employment growth, that the inflation shock is thus far largely being absorbed.